to help to be more creative and come up with your own approaches for things that maybe others are not doing. Versus if you use just the industry tools, you're just following others all the time and just like doing the exact same thing.
Welcome back, passive investor, to another episode of the Passive Income Adventures. If this is your first time here, we talk about the dream and the reality of seeking a passive adventure income lifestyle. We talk about the dream and the reality of seeking a lifestyle that is powered by passive income. Today, we have Stefan Tsvetkov, and he is a data scientist who uses that insight to be able to predict the best markets and narrow down to the best deals in those markets. His insights are fascinating. If you are into data science at all or being able to look at data to be able to make financial decisions, his brand Realty Quant and Finance Meets Real Estate really can dive into the weeds with this stuff. And so if that's something you enjoy, I encourage you to listen in. If that's something that you don't enjoy, sometimes it's great to find people who do enjoy it and invest in the things that they're investing in. If you can understand it well enough that you can look at what they're doing and say, that's where I want to be. We talk a lot about on the show about mimicking people who are making great decisions, who are winning at life and making the passive income lifestyle work for them. Stefan is a hard worker and an entrepreneur who got into this lifestyle so that he could pursue more passive income and have the freedom to be able to work on the things that he's really passionate about. You're going to see that passion come through in this interview as we talk about all sorts of market conditions that would make an investment a good option. Even though I worked in the data science space as a marketer and my husband was in that space as an IT guy for a really long time, this is still a lot of things are over my head, but listening to it be explained by an expert really helped to bring it down to my level where I could understand it and actually use that kind of data to start making investing decisions and using that data to be able to start identifying people that I want to invest with who really understand this, get deep into it, and are able to make really smart decisions based on data. We're in the information age, and being able to use every drop of that is very important to successful investments. So buckle up, enjoy. Stefan has a lot to teach, and he will open up a lot of rabbit holes that you can go dive down after the show. Please be sure that you connect with him, watch his webinars and his YouTube channel, because there is a lot more where this came from. So enjoy the interview, and I'll see you on the other side. Welcome, investor. We've got Stefan Tsvetkov with us today from Realty Quant. He's a data scientist who uses his background to be able to find the best deals in the commercial real estate space. And he's going to tell us today a little bit more about his passive income journey. Thanks for joining us today, Stefan.
Hi, Emma. It's a pleasure. Thanks for having me.
Yeah, thank you so much. Can you just kick us off by telling us a little bit about your background, where you basically started in your professional career, what types of influences led you to that, and maybe some pivot points where you thought, I really want to look more into making passive income and being able to just chase a different kind of lifestyle?
Yeah, absolutely. So I'm Eastern European originally. So I came to New York City at 22 and I went to grad school here and I worked in finance. So I'm a financial engineer before. By background, so I worked in finance for about a decade. And then in the recent, 2-3 years, depending on how we're counting, I've been in real estate. And so I'm a full-time real estate investor. Started with residential investing. So I was doing condominium conversions of small multifamily buildings close to New York City. And I transitioned to commercial multifamily subsequently. So I'm working on my third apartment complex acquisition right now. I also run Realty Quant, so data analytics company. So that's, to your point, leveraging my previous background in finance and data and all that, like financial engineering background. So Realty Quant, it's a property analytics, market analytics company. So one piece of data that we provide is which markets are overvalued. And then we also have apartment complexes that have data on nationwide on apartment complexes, like CoStar.
The part where you're talking about how you're using your past job or your data science back to start inform your investing. I had a similar experience where I was a marketer. I graduated from college with a degree in entrepreneurial management. And my internship was actually for a data science company where we basically did scientific computing with Anaconda and a lot of
nice.
A lot of customers who were looking for huge data sets to be crunched. And so being exposed in that world, I always realized when I first jumped into real estate, we would have people come up to our meetups who were data scientists trying to look at huge data sets and be able to predict trends in real estate. And that little bit of experience helped me say, hey, this could be really powerful. And I was watching more data scientists come into the space. Can you tell us what led you to that decision and led you to that pivot?
Yeah, it's a great question. For me, at first, it was just a way to find deals and search for deals when I was back in residential investing in the New York City area. So what I would do is, you mentioned Anaconda, right? So That's like an application for Python essentially. But basically, so I would use like Python and get, I don't know, like basically every property within 3 hours of New York City, maybe like about 6,000 of them that are like small multifamily buildings, like 2 to 10 units, let's say, something like that. And I would just underwrite them. So just have a code, underwrite them, and I kind of screen for deals. So that was like screening for deals was the first step, how I got into it. Then at the beginning of COVID, I started looking into markets more and trying to forecast like downside and appreciation and things like that. And that led to some findings, I would say, like where it seems like in real estate, like it's a very fundamental asset, like where you can, like fundamental studies work. And so I started getting into like fundamental analysis for markets and essentially estimating like what they call market valuation. And Realty Quant is now, my company is actually one of the main vendors for market valuation, essentially like covering 3,000 US counties in terms of coverage, in terms of having like very extensive coverage of which counties, which metro areas, etc., are over, under, fairly valued as we potentially go into a recession or don't go into a recession, we don't know, and so forth, but what kind of valuation those markets have. Then I also started looking into other like more machine learning things. So I've been doing like automated valuation and trying to play around with that. Some modeling for apartment complexes for the commercial multifamily side. So a product that we recently released at Realty Quant is essentially modeling apartment complexes based on rental listings data. So based on rental listing data, trying to gauge, okay, which complexes have more value add. As I am like pretty much not everybody is a value add investor. Many investors search for value add, right? In the commercial space, so like trying to estimate like, which buildings have upside in their rents, in their other income components, in their expense side, perhaps like utilities, etc. And you can do this thing at scale. So, for example, I did a lecture for my webinar where I was showing, okay, essentially estimating value add on 32,000 off-market apartment complexes. So it's pretty extensive. It's very preliminary on the other side, right? Because it's like something that you do like very early on. You don't know a lot about all those off-market complexes, but it can guide you. And for instance, like for people who would, let's say, use their CoStar and call those building owners over the phone, now they can focus on maybe the top 20% complexes in their market and just not waste time with the ones that don't have an upside anyways. So this kind of modeling, and it's a different machine learning. Condition scoring also is another one, like kind of property condition scoring is an important machine learning tool, I would say, that and automated valuation. And so it's just different data tools for markets and properties, basically, that I've been building over the past 2 years.
So it sounds like it's really useful for people on the acquisitions side of things. And so how are you able to then turn that around and start doing your own acquisitions?
Yeah, it's a great question. So I have 3 interns that work with me for acquisitions. And so I have a system built out for them where to search for deals, which would essentially and that's a little controversial, but would start first with on-market stuff. So we'd start even with on-market. Nobody likes on-market. There are no good deals on market, as most of your audience knows, but start with on-market because that's readily available. That's already there. It's free. You don't have to pay for leads to do that and so forth. And so let's say we would get things like Crexi and like services and underwrite the whole Crexi, like anywhere. So like the whole US of Crexi even and so forth. So in different states, and then it would go through our market filter. So the thing is that because we're relatively forward into the market side, it's extremely important to follow valuation from a value investing standpoint. And I can talk to that more. And then it would go through our market filter for which of those markets are actually under to fairly valued. And so we, as a policy, like at least our investment strategy, my investment strategy, there is just basically to do only those markets. So we don't invest in any overvalued markets that carry any kind of recession risk. So one of those may fall in the Midwest, in the Northeast, and some of them to the South. And so then I have one intern covers the Northeast and I know it's not a very big focus in terms of markets in that sense, but that's what we've been doing as far as like a data approach. And so like finding deals like different places. And so that would start with all market. Then we would use the apartment complexes off-market modeling, which is also a product that Realty Quant for others to use as well. So we would use that one to just screen off-market properties and do some direct-to-owner, like phone calls and so forth. And then the third, and then what else? There's always agent relationships, even if you're doing a data-driven approach, I would say. And then social media. Okay, social media. So we use like machine learning to do text classification to classify basically get like all social media posts and classify them, which ones are actually selling apartment complexes, and then have those underwritten. But the spirit of this is that there's like systems that try to do automated underwriting everywhere. So as much as possible to be computed for you, even though it's not great and you have to look at it, you have to obviously go in person and look at that property and so forth, but have it as much as possible underwritten. So basically a mix of everything that's on market gets underwritten by default. So we have everything that's on market. Everything that is then off market, that modeling, that is a pretty unique way. I haven't seen somebody do it before. And then meaning the off market rental listings data modeling that actually gives you which off market buildings are the good ones. And then the third one, social media. And then the fourth one is just agent relationships. And then we would use data to pull which are seen to be the best agents in every market. And on the market side, it's actually quite interesting on the market side. So I've gone and studied like every recession the past 40 years and looked at predictors of downside risk following the global financial crisis and other periods. And so what I found is that actually was like very high correlation of, let's say, like deviation from fundamentals, which are, let's say, income, population, and housing supply, and then the decline. Now, it may sound obvious, but it's not necessary, because if you have something like a stock market, it doesn't work. So this kind of fundamental approach doesn't work so well. And so, for example, like metro areas that were, let's say, 40% overvalued ahead of the global financial crisis, they declined more than metro areas that were 10% overvalued. So this correlation was extremely high. It was almost scientific at the metro areas level. So it's something that one can actually use. And it's being published actually, besides Realty Quant, it's also published by Moody's Analytics and Bloomberg Economics. And there is a study at 40 that one. And so those kind of studies, they work. So I've been kind of like speaking to people and like other investors on, okay, you guys have to use this because like super easy. It's super easy. It's available to you. You don't have to go and invest in a very overvalued market. And so that's the other thing that is very important. So like being a value investor on the market side and not paying a premium to markets. Because I know investors, they get properties at a discount and they're very conscious of not paying a premium to the property itself. But not paying a premium to markets is very important. It's like an example of that would be Austin right now and a few other markets.
Yeah, where we lived in Austin for 20 years. Watched that market go from a normal kind of pokey little town up to what it is today, which is a volatile and just fairly overvalued and volatile. And so it's been difficult to invest there because it's hard to predict those kinds of trends. And we were in Austin because it's like the data science and semiconductor mecca. And so I found that those kind of tech towns tend to become overvalued very quickly. And that's where the data scientists and the IT guys tend to congregate and looking at. And so taking that information that you're getting, it sounds like what you're doing is being able to narrow things down in a funnel so that you not only just which markets to concentrate on, which properties to concentrate on, but then you can take it down even further and figure out which relationships to focus on, like agent relationships, broker relationships, and then even to the point of attracting capital. How does that help you when you're actually acquiring a deal? Because you're getting through all of that noise to really find the best opportunities, but then you have to pay for it. So how do you take what you're doing right now and narrow that down into being able to attract the right kinds of capital and focus direct relationships in that venue as well?
Yeah, it's a great question. I think for me, it helps because, you need to have your own, your own reputation, right? An image or whichever is directing it to an avatar, right? And this kind of like marketing people can speak better to it. So for me, it definitely has helped to find partners, to find investors as well. On capital raising. So I just finished capital raising my second apartment complex, which closed this week, and I'm working on the third one now. And so I think it helps a lot, in my opinion, because it's your differentiating thing, right? And you have your skill set and you showcase your personality. It's like with everybody else, right? You have to showcase who you are. And so for me, this is a very genuine I think it's a very genuine activity that I've been doing honestly for myself, for my own investment, that I didn't share with others as well. And so definitely doing data-driven investing has helped me, I would say, on capital raising or sourcing partner relationships as well.
Are you able to leverage that to be more targeted in how you market or find the relationships for your potential investors so that you're not spending too much money, time, effort, attending conferences that are not going to get results, putting up ads that are not going to get results? How do you take that data science mindset and apply that towards really focused investor relations?
Yeah, that is a great question. Yeah, and so that's using data for marketing, right? There is a lot of
I'm a marketer.
I know, yeah. So that I've been trying a lot. Actually, I've been experimenting a lot with my marketing, and I've taken a step back now and focusing more on purely the acquisition side and trying to focus on that. But yeah, I've been writing a lot of scripts to automate. For example, so I run a webinar called Finance Meets Real Estate, and we are one of the bigger meetup groups also in New York City, maybe I don't know, the top 10 or something like this. And so let's say, so for that meetup group, I would try to scale it and acquire like new people like to join and so forth. And I would be writing kind of Python scripts for that, because then we open like groups in other cities and then like being able to like post in multiple places. So like it does help with automations if you can do your own scripts, because otherwise, I mean, you have to pay for all these different vendors to do it for you, which also is a good way, but you're more flexible. You can come up with a totally new idea. The difference like with this is you can just come up with something nobody has done. And it's, for instance, like the apartment complexes, rental listings, that modeling for off market. I know that because I use CoStar occasionally and I don't pay for it, but I use it from like other partners and so forth. And so let's say it's not in CoStar, right? And so the benefit is like really being able to be flexible and tune to your own needs. The expense of that is that it's a lot of labor to be building all those data, writing all those scripts and writing thousands of lines of code, and or having somebody write them for you and spending money on it. So it's not cheap. So there is an expense for sure. It's marketing has become extremely data driven. We've been doing Python scripts to post on like multiple Facebook groups. Let's say post on 100 groups, things like that. So social media posting, meetup posting can be partly automated. I'm just trying to remember. It's not too fresh in my head, like all the things that we've done on that end. Because I sort of reduced it a little bit recently. But yeah, definitely it's extremely helpful. Very much it's like browser automation. Example, it's fun. It's like automating browser actions and so forth. It's very useful and it can help you. It's like having a virtual assistant of sort. If you need to do like many postings, it's hard to maintain those systems as well. It's a lot of work. I know a lot of the marketing companies, they're building like some of those same things, but definitely like a data-driven approach is very useful in marketing. I've been doing it. I had some success before. It helped my YouTube channel and my meetup at some point.
I know that what you said before about having a personal brand and really being able to find the thing that differentiates you, the niche that gives you an edge. And so you have this background and this product basically that helps you, like I said, narrow down the best markets, narrow down the best opportunities, and being able to then take that and apply that to the new venture that you're doing. And with me as a marketer, I was able to say, oh, okay, I'm going to go out there, I'm going to do social media to attract capital, and I'm going to found my first deal on social media. And now that my husband has left his IT job, he had a specialization in continuous integration and automation. And I said, hey, you can come into my business and help me automate finding deals, help me automate finding more investors. And he got in there and he thought, I have no idea these tools that you're using, because the tools that he was using were very professional level. And he gets in there and he's looking at what I'm using, and it's more of a consumer almost or like a marketer based instead of a technical professional. And so it was difficult for him to make that shift from his old job basically to his new job and learning all of this new set of tools that is just doesn't do as much as the ones that he's used to doing. Have you experienced any frustrations like that as you've been turning that corner into more of a multifamily operator?
Yeah, that's a good question. No, I know like some of those tools like Zapier and all those tools, I felt that they're pretty great. I don't know. I think for me more the difference has been that there are things that I cannot do with them. So I just come up with, it's more creative otherwise. You just come up with your own idea. It's like market valuation for me. Say you have syndicators, they invest based on population growth, income growth, and those kind of things. And I know that right now that's not the correct approach. I know it may sound strange, but I know that I've done like data studies that essentially suggest that, okay, at the end of a market cycle, it doesn't matter for population growth and all those things, they don't matter anymore. The only thing that starts mattering is the market overvalued or not. And that's like what drives like perhaps a period of at least 5 years ahead. And so for me, like this is the key metric. And so if I talk to like all my other friends or like people like who are maybe buying like a apartment building, I know they're not using that. Okay, fine, but that's by contribution or something that I found to be, and it's not like an invention obviously because it's used actually by the institutional level by big firms and so forth, but it's something that I have found that it's actually extremely useful. And so that's like the difference, just you help to be more creative and come up with your own approaches for things that maybe others are not doing. Versus if you use just the industry tools, you're just following others all the time and just like doing the exact same thing. If I didn't know, let's say, for instance, the market side is extremely important for now. I now accidentally end up completely contrarian. I'm not intending to be contrarian. I prefer to follow the trend. I like to follow the trend. I want to be where the trend is. But, okay, because now there's a situation, and just kind of to speak to it, like for your audience, so Drew, it's kind of like I mentioned, messing with market valuation. And so how overvalued different markets are. Just that's so it's simple. And some of Western markets, like you mentioned, Austin. So for instance, like Austin, I think was at the peak, like in the 60s, over 60% overvalued, actually, like at the peak of the second quarter of 2022. And since that, Austin had declined 8-9% on just the pure housing markets. And so it's not commercial. And then, okay, commercial is different and so forth. But just the housing market, which does correlate very much with apartment buildings, even though people say, okay, there are different valuation approach, obviously, as if you control that valuation and so on and so forth. But it is pretty similar asset fundamentally, and it correlates. And historical correlation is around 91% on the price level, actually, between like CoStar, multifamily, and just the housing market in FHFA and things like that. And yeah, so to give an example of like how it helps me, just very practical, where have investors been purchasing properties like this cycle? Okay, so they would go to Texas and Florida. The biggest operators invest in Texas and Florida. And then they would go to all those other Western states, which are like smaller ones, like Arizona, Nevada, Idaho has been the top performer, okay, and so forth. And okay, so all those other states like Arizona, Nevada, Colorado, Idaho, and that. And so those are the booming markets, just purely looking at price histories. So now, if you do not do this type of data study if one doesn't do the type of data study, for instance, that I have, like the thinking would be, okay, those markets, maybe they can get some impact in a recession. It just becomes this uncertainty in your head, like as to what's going to happen. So like they might decline like 10%, but then are they going to go up significantly afterwards? And since they're those fundamentally strong markets. Now, doing a more rigorous data study shows things to look a little differently. And so, for example, like I did this presentation again at my webinar where I was showing, okay, 10 years ahead appreciation for if you purchase markets at different level of valuation. So if let's say all the metro areas in the US bucketed by which ones are in the 30 to 40% overvalued, which ones are in the 0 to 10%, which are in the 10 to 20%, and so on and so forth. And for each of those buckets, what was the appreciation 10 years ago? And so that's basically what every investor wants to know. So it's not only, okay, is it going to decline now, but then it's going to do well afterwards? And what it suggested is that buying at lower levels of valuation outperformed consistently ahead of a mild recession, such as 1990 was an example of a very mild recession that almost nothing happened for real estate, and then ahead of a very severe recession like the global financial crisis. And so basically you have a situation where, let's say you bought at the 50% overvalued mark, and then the 40% and 30% and downwards up down to 0 and minus 10%, let's say. And 10 years ahead, every higher bucket underperformed the lower ones, like almost perfectly. And that was like that following global financial crisis, that was like that following 1990. And so that is extremely interesting because what that suggests is, okay, like this kind of like value investing, like being like a Warren Buffett type of thing in real estate. So that kind of tells you, okay, it matters where you buy that market. So that tells you it's a different, what the data suggests, it's a different result than what most syndicators I speak to would say, that they would say, okay, if Austin is a very strong market, it's strong fundamentally, it may decline now 10, 15%, a little bit in a mild recession. Let's say that most people expect a mild recession, right? But afterwards, it's going to outperform. But that's not what happens. That's not what the data suggests. What suggests is it will underperform, and it underperforms for about a decade forward. And the reason is you bought it too high. You bought it 50% overvalued. And as the market in cycle, that becomes like a pressure to it, because in a way, like you get, suppose it still has stronger fundamentals than something like Chicago. Okay, so it still has, let's say, stronger fundamentals. It does, but the delta in fundamentals is maybe 10%. The delta reduces after a recession, just like none of the markets are doing all that great. So like income growth worsens and so on and so forth. And again, we don't even have a recession yet, but just speaking on that. And so what happens is that delta reduces, but you have a market that's in valuation terms like 50, 60% above. And it's a big pressure on it to actually outperform. It's extremely hard to outperform. And it never did, it seems, like in previous recessions. And so that's like something that's extremely for investors, other investors to speak to understand, and I show them a chart that, okay, that's how it looks. That's what it seems to be. And so this is the situation. And then an example of that was Hawaii, for example, ahead of 1990. So Hawaii had like triple digit appreciation, had super exploded in appreciation. And whoever was investing in 1990, they would be looking at the fundamentals. So, and that's where one should not invest purely on fundamentals only, but also the deviation from fundamentals, the interplay of prices with those fundamentals. Because if you look at only at fundamentals, okay, we would say, okay, Hawaii at that time, this is the best market. And it would be correct. It was the best market. But that same best market then underperformed everything else. The reason is in 98, 8 years later, prices were lower than they were at the peak, while other markets, they just continued and went forward. And so it matters where you buy a market. And that's like it's a very simple measure that is used at the institutional level, because at the institutional level, so for example, my company, we speak to the lending industry, so companies that purchase institutional credit. So they are, I would say, a bigger customer focus for us than investors. The reason is they actually use that stuff. So they actually use, if markets are overvalued, they use all those things. They care about it. They would make loan-to-value adjustments and so on and so forth. Investors, generally speaking, don't. There are good reasons for that, because they're local. They have to focus. They're optimized this way. This is their best use, right? To be local, to have their agent relationships, to have their knowledge of that market, and so forth. But still, what if happens to be that market is now at the 50% mark? It just puts a lot of pressure. And again, like to explain, like that's not something where I would say like it's doomsday type of scenario. Not at all. Actually, if something is 50% overvalued in a milder session, would decline not much, like 10, 15%, like 15% was generally the decline, let's say, following a milder session. And then if it's a severe recession, and the only one that ever happened that was so severe was like, whoa, financial crisis, like 40% decline. But again, it has nothing to do with that. How big the decline is, by the way, is a separate question. That is up to economists forecasting economic, but the level of overvaluation is already there. And whether it declines or it doesn't decline, I don't want to say it doesn't matter, but it's the secondary question. It's like, the question is, either way you get underperformance that you bought that high. Whether that underperformance was through a 40% decline and then the price is catching up, or through just a 10% decline, it's secondary. Like 10 years ahead, like that market was very stagnant and it didn't perform. And so that's how it's very interesting to observe it and realize that actually markets kind of change regime. And that's where, so I did this kind of presentation, and it was showing that, okay, even if Midwest and even Northeast with all its regulatory issues are very fundamentally poor at their fundamentals, right? And not so great markets at the moment. And even though they're worse in their fundamentals than the South and the West broadly in the US, that the likelihood that Midwest and the Northeast outperform if we get even the mildest recession is extremely high. So that's how then the market kind of resets, and you can stop, and then a new trend gets set. And it could be that again to the South, the next cycle afterwards, again, Southern markets emerge back again. It could be, and that's very possible perhaps. But for some time, they underperform. And so, so these are like other kind of findings. Once you have this perspective, then for instance, like for my investing, it all has to filter through this. It all has to filter that, okay, even if I'm buying a great deal, it shouldn't be in that overvalued market, because I don't want to have a deal that I will make money on the deal side, but then the market takes it away. So you don't, even though you're somewhat protected, but you don't want to have that. And so then, okay, so we just filter basically everything that's up to maybe 5% value. So 5% of fairly valued, or it's even undervalued. And so this kind of the approach, and that gears towards market, okay, maybe they might have operational risk, or they might have other kind of issues though. So there is a trade-off. But again, that's the tricky part. So I would really love to invest in Florida right now, for instance. That's what I want to do. I don't want to invest in Northeast or the Midwest. But again, do I want to carry that market risk in Florida? No. So it's there are lots of insights, and it's very impactful, I think, doing like data-driven investing. It just makes you have a brain of your own, not just follow the crowd.
Yeah, usually by the time the crowd is doing something, it's usually a little bit too late.
Yeah. But also, I'm not suggesting you need to be contrarian or something. It's better to not be contrarian. It's best to follow the trend. In fact, in real estate, that's proven by autocorrelation studies. Oh, there's autocorrelation, there's trend. So like this year, price performance correlates to last year price performance. In fact, in Florida, I think autocorrelation ahead of some of the recent slight declines that started happening and so forth. Autocorrelation was extremely high. It was close to 90% in the whole state of Florida. So it's extremely easy to forecast Florida doing well into the future and something like that. Yeah, so it's not meant to be contrarian. It's just meant to be based off whichever evaluations are there. So and you can track their history. So for instance, in 2020, a lot of the Western markets and states were still fairly valued. Utah was fairly valued beginning of 2020, and many other places. And it's overvalued now, but that's just because like inflation and like printing money, and it takes really accelerating in 2021, 2022 partially.
If we're in a shifting market, sometimes the trends start to shift. And so being able to predict that is somewhat of a contrarian activity because you're looking at things that have been going. But then when we're to see that market shifting, you have to take a step back and say, okay, are these trends going to continue or are they going to go on a different path? And so being able to identify that divergence sounds like that's the point that we're at right now. We're at that crossroads where we're having to ask ourselves, are these trends continuing or do we need to start looking for new trends that are just in their infant stages?
Yeah, and that is a great question. But one thing is, I would say if one looks for like new trends, then it's hard because that's forecasting things that maybe are hard to forecast indeed. But I think what I tell to people is that overvaluation is built into the market. That's not actually forecasting. That Austin is, well, that's not, people are not going to like information. But let's say, okay, Phoenix.
Meet up on Salt Lake. I live there now, but I'm watching the same thing happen in Salt Lake.
Salt Lake City, I don't remember the exact percentage in Salt Lake City, but it's around 40%, I think, off the top of my head, overvalued. But okay, so Phoenix, let's say Phoenix was at about 48 overvaluation in the middle of 2022. Now, Phoenix has been declining since then. And Phoenix and Austin and Boise. Now, Boise was the top performer since you're in Iowa, who was the number one price performer. So Boise outperformed Austin in terms of just purely price appreciation of their housing market and outperformed everything else.
And now it has the biggest drop.
It has the biggest drop now. Yeah, a top three, among the top drops, exactly. But then Boise is something that, okay, I was in 2020, I was at best ever, okay, not like to be dropping names or whatever. And that was my topic when I was starting with real estate. This was my topic, again, like kind of like how overvalued markets at the time. And the discussion was exactly how, okay, broadly US real estate is fairly valued, but Boise and some Western markets are overvalued. So Boise was the pronounced exception at the time. Now, that said, doesn't mean that Boise did not do incredible afterwards, or even that it wasn't expected to do incredible because it was overvalued. In fact, there are studies where if you purchase, the more overvalued you purchase, these are our own studies, so, or my own studies. So the more overvalued you purchase, let's say on a 1 year ahead performance, in the years ahead of the end of a cycle, you tend to outperform actually. So it's even, because there is trend, there is momentum. And so buying an overvalued market actually benefits you on a 1 year ahead or 2 year ahead horizon, maybe, but then on a 10 year ahead horizon generally never does. Yeah, so Boise, I think, reached in Q2 of 20, Boise was around 33% overvalued in 2020 when it was at that podcast. And then at 2022, middle of 2022, it reached to like 77%. And so Boise now, I think, has declined maybe 8% so far. That's just the housing market. It's not commercial. But Boise was always known to be, like, for 2 years I've been talking about Boise. So that was like always there, just to put it. And that's not just me. That was actually Mark Zendik, who is chief economist of analytics. They were coming up and they had Boise as the number one most overvalued city. And we've had Boise as most overvalued city for 2 years. And then for the Atlantic University, which I mentioned before, study, they also had Boise. So everybody gets Boise as the most overvalued city, whichever methodology you want to use, because it's just really far up there. So that's the situation. That's the situation with that. But from there, like investing in a market like Austin, let's say, or Phoenix, 48% overvalued. Again, like if we get a mild recession, it doesn't mean it's any terrible situation there. Something that's around 50% overvalued could decline only 15, only 1.5, let's say. It doesn't mean it has to decline with the full amount. The reason for that is, and we're running out of time, but one reason for that is that real estate declines following recessions, even if they were mild recessions, in overvalued markets, they to take 4 to 6 years. That's since global financial crisis, a lot of the stuff was overvalued anyways. If you just take price histories, like following global financial crisis, has no modeling at all, just price histories, decline started in 2006 and then ended by 2012 in some markets, so like 6 years later. So it's a very slow and lengthy process. So it takes a very long time. And so because it takes such a long time, if you have a strong recovery, such as a mild recession has a strong recovery. That's 90, for instance, with regard to mild recession. And global financial crisis was a severe recession because actually classified for the past 2 centuries from, I think, Pew Economic Research classifies it as one of the most severe recessions. So it has a very weak economic recovery where incomes didn't recover. Because they don't recover, you end up with the full amount of the overvaluation resolved on the price side. So that is the issue with severe recessions. And so essentially, if you have something that's 50% overvalued and you get a severe recession, all that overvaluation could be resolved on the price side. And that's the real issue if you get weak recovery. But if you have a strong recovery, you just get a 15% decline. But in either of those two scenarios, and that's like that study for investing in undervalued markets ahead of a recession that I did, that people can be found at my website, realtyquant.com, is actually suggests that either of those scenarios, it doesn't matter whether you get a 15 or a 50% decline, or it does matter, but it's secondary, you still underperformed the future, and you still should have chosen kind of the investing in value in that sense. And some reasons to that is, okay, perhaps real estate is it's a simple asset. It's housing, like people's homes and so forth. It's fundamental. It's driven off income, population, housing supply. It's not something that has like that much of a technological component. It's just very easy to value. And yeah. Okay.
I could get into the weeds here for another couple of hours. I'd love this stuff. And I have been hearing that from the data scientists who are putting their trade towards the real estate, that the top considerations over during this recession and the subsequent recovery that we're expecting, we don't know how bad it's going to get, but that the top considerations are the overvaluated cities and affordability. And so being able to buy a property that is undervalued in a city that might be a little undervalued is going to create more affordability so that people can actually afford to live there, rent there, work there. And have you found the correlation between those two to be pretty direct?
You mean overvaluation and affordability?
And affordability.
So that is a great question. Do you know the best way to estimate overvaluation, the simplest way to estimate the overvaluation is deviation in affordability. So if you want to model it in a more precise way, you would use population, income, housing supply, like all the factors. But if you want to approximate that, and it's a great approximation, and that just shows like it gets that real estate is just very simple and straightforward, is taking price income ratios on let's say 20 years or whatever, and deviation from price income ratios, and that will get you roughly the same result. That would give you that Boise's at the top and other markets are at the bottom and so forth. And deviation in affordability is what drives downside risk in a recession. It's not affordability itself, because New York City is not affordable. But New York City right now, but New York City right now is actually fairly valued. Okay, that just happens to be. It was somewhat overvalued ahead of global financial crisis and so forth. But right now, New York City, I think as of latest I could see, it was around 3%. And so affordability is not a driver of downside risk following a recession, but only if it deviates from its regular level of affordability. If it's just always not affordable and it stays at that level, the prices are just going to stay the same. Now, there is another thing that is happening that is conflating valuation studies, where my model, for example, is wrong, is California. So right now, markets that are declining is every single market that is overvalued, plus California markets. So California markets, I just have them entirely wrong, actually. And the reason I have them entirely wrong, it's just they're not overvalued. So California is somewhat overvalued. California is extremely not affordable, but not very overvalued, just based off because everybody has been investing in those other places, right? Nevada and so on and so forth. And then away from California investing. And so it hasn't actually driven this excess appreciation that much, but there is some excess appreciation. But then if you take cities like San Jose, it was actually undervalued. So by valuation, that market should never decline at all. Now, what is happening now, and that's where indeed you can always get something new, always, right? You never know for sure, is that there is suburban trend. Suburban trend is a huge thing. Suburban trend is like the equivalent of internationalization of labor in the 50s, where you get to outsource, and it's effect, let's say, in the Northeast and other places, right? Where you get to outsource labor from China, and now all those manufacturing jobs disappear, and you get like huge population outflow. And so now suburban trend is the same, but with white-collar jobs on top of that. So you have San Jose that is completely not overvalued, was not overvalued, but is not supposed to decline in a recession on its valuation at all. But now suddenly, it's 10% of its population that are white-collar, high-earning professionals leave that city, and this is a very big issue. So that's like the fundamentals erode. And now, personally, I have not been modeling so much that side because I could, but I have not focusing on that because I don't have the time, perhaps. And so that's where, like, I'm not forecasting things like that. The fundamentals might so dramatically erode. But that's what happens as far as places like San Jose. And so that's a different thing from in the past, where in the past, like the previous recessions in the last 40 years, every single recession, there was never an undervalued city that ever declined much. They would decline. The average decline was, not that they were declining, meaning they were declining. The declines were like 1 to 6%, very small declines. Yeah. So even in the global financial crisis, like they declined like 6%. All the undervalued like metro areas, like if you invested in Texas, in fact, at the time, many metro areas in Texas, and then you would have had like great returns decent returns following the global financial crisis. That was, for instance, I think Vinny Chopra, who did his first syndication following the global financial crisis. He was in Texas. Texas was undervalued. He didn't have almost any decline. And he just had like very high IR at his project. But then, okay, Rothcliffe, okay, he was investing in Florida. Hope they don't listen to this, let's say in that sense. And so he was in Florida, and Florida was very overvalued and losing like significant, his net worth or something like that. And that's where it's extremely important at that point where you invest. So you want to be like Vinny Chopra in Texas ahead of global financial crisis and not like Rothcliffe in Florida. But to your question, so affordability and overvaluation, they don't have a correlation per se. It's the deviation in affordability that drives it. It's where like when people track affordability indices and they say, oh, those cities are very not affordable, that doesn't tell you anything about what's going to happen to prices. They continue being not affordable. They will just keep going on. That's just what happens. But if they deviate too much and it's not explained by the fundamentals and so forth, then that's only represent. And that's how New York City, that's what I'm trying to say. So overvalued and not affordable are different things. New York City is not affordable, but it's not overvalued. But where suburban trend right now, just because it's a very white collar type of situation of population outflow, it could affect New York City. Now, we're not seeing like big decline at all in New York of prices so far, but in the California cities there, that has been a big effect. So I think those are the two things to track now, to be honest. Like as far as I think population growth, all those measures, they think they don't matter so much because population growth, if you invest ahead of global financial crisis and you purchase in Nevada. So in Nevada, population continued to explode. It continued to increase. And yet prices crashed in half. In spite of that, population alone is not sufficient. It correlates around 40% to prices actually, which is decent, but 40%, it's just not enough to explain like everything. And I would not track growth fundamentals so much anymore at the point where there are markets that are 20 to 50% over. I would focus on valuation and then tracking like where population trends of just like and jobs that are heavily leaving certain markets, like what happened to San Jose.
This is fantastic stuff. Let's shift gears a little bit so we can wrap it up. But I know that you put out webinars and I know that you have a lot of information on your website. So can you tell us where those of us who want to dive into a little bit more can get a hold of you and get some more information on some of the things that you're talking about?
Yeah, so they can go to realtyquant.com. And so we have the data for every county in US pretty much over there. They can read like some of the articles that I post. You can also follow me on LinkedIn, Stefan Tsvetkov on LinkedIn. Also, I have a YouTube channel, Finance Meets Real Estate on YouTube.
Awesome. Yes, I've been enjoying that one because this is the kind of stuff that as a marketer, I don't really dive into the acquisition side as deeply, but it really helps me to understand what operators I should be interfacing with that are going to find the best deals and then operate those in the lowest risk way possible. And so I know where to put my money and I know where to help our investors put their money. So thank you so much for sharing with us, Stefan, today. Like I said, I could go on and just listen. I'm loving the webinars, the YouTube channel, and just really being able to geek out on this kind of stuff. And so if it's something that people really want to dive into, you have the resources out there. And if it's something that people are like, wow, okay, I don't know what's going on here, just find people who do understand it, find people who are able to take these insights and find the best deals and make sure that you're investing in the best places and the best opportunities because things are uncertain right now. And we just want to make sure that we're making the right decisions with our investing dollars. So Stefan, thank you so much for coming and spending some time with us and teaching us about how to figure out where we should be investing, and appreciate your time. And hopefully people can reach out to you and get a hold of you on your website and just be able to be in your network and see what projects you have coming out next. I hear that you have some good stuff.
Yep. Thanks, Emma. Appreciate it.
I was not kidding that I could have spent hours more in the weeds with Stefan, just hearing him teach me about the things that he's obviously so passionate about. So again, I encourage you to reach out. He has a lot of content on his website and his YouTube channel. And I want to hear from you too after the show. Be sure to reach out to me at highrise.group/content. We have links to all of our socials, our YouTube channel that tries to take these real estate concepts and help you make better decisions so that you can get to your passive income lifestyle sooner with more information, that you're armed with knowledge so that you're taking less risk. The more knowledge you have, the less risk you take. And that knowledge comes from people who have been studying and walking this path and sharing breadcrumbs behind that we can learn from. Thank you so much for joining us for this episode. I'm really looking forward to talking to you. And until then, I'll see you next time on our next passive income adventure.